In this week's Property Insider chat, Dr. Andrew Wilson and I discuss how loan approvals have decreased a little bit, but in loans to investors have risen significantly over the last year. Yes, investors are back, but they're looking at particular states. We'll explain where they're looking at. And we're also going to talk about home building costs that have risen again a bit and what are the implications for our housing market. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you updated each time a new show comes out. According to the recently released data by the Australian Bureau of Statistics, new home loan commitments in Australia experienced a slight decline. While this decline isn't drastic, it serves as a barometer of our housing market's health. So are potential home buyers and property investors just taking a breather, or should we read more into this data? That's one of the questions I want to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market, in this week's Property Insider chat. Hi, Andrew.
Yes, good day, Michael. And yeah, we had a slight decline in the home loan series from the ABS over May, but I don't think we should read too much into that. The home loan series has been a little volatile. There were some issues last year, the ABS alerted. In fact, they stopped producing the home loan series for quite some time, a few months, and because two reasons: they were having issues with their seasonal adjustment modelling, and we've discussed that here, that through COVID, of course, the seasonal adjustment modelling sort of got out of whack because stronger months became weaker and weaker months became stronger. And of course, the seasonal adjustment is about backtracking over time, and modelling the weaker and stronger months, and then making account or taking account of that. But COVID sort of messed that all up. But the ABS was also saying that they were having some problems with the actual collection of the data. From the banks, particularly, and they wanted to revisit their actual modelling, their actual data collection process. I still think we have some issues around that, although certainly I think the home loan data continues to be another correlating indicator of what's happening generally in the housing market. But yes, look, down 1.9% after three really strong months of growth earlier in the year. And of course, that does reflect what we've seen in auction markets, auction clearance rates, and auction sales. And of course, in-house price growth, home price growth has been also continuing to rise. So no surprise there. Perhaps a little bit of a consolidation over May following a strong month over April, and also perhaps a little bit of a holiday effect coming through from April, with maybe if you have a lag from, buyers turning into borrowers over the month, but certainly still quite a strong result. And we're now clearly tracking higher than where we were last year at this time, Michael. So
I think that's important to recognise rather than just looking month on month.
Yeah.
If you look over at the last 12 months,
Yeah.
home loan commitments have risen 18%. Now, sure, property values have gone up, so the value of loans in some states
Yes.
have gone up.
Yes.
But despite that, the total number of loans has increased, hasn't it? More people out.
Yeah, absolutely, Michael. And we look at the value of loans here, of course, and that is influenced by higher prices, reflect, you've got to borrow more to pay more in the property market that's rising in terms of higher prices. But still, nonetheless, the trends are clear, not just in relation to higher prices, but higher prices mean more demand anyway and stronger markets. So they both relate to the same output, which is more buyers and higher prices in the marketplace, more borrowers. They're borrowing more, but the market is certainly remains quite robust going forward, particularly for this time of the year. And when we look at the auction results, that will validate that. But we saw when we look at the buyer breakdowns, the buyer type breakdowns. Again, all buyer types were down over the month. So always a little bit wary of that, and it does mean perhaps there's sort of an underlying seasonal impact there occurring when all buyer types were roughly the same in terms of their decline over May. And what we see when I guess we can compare the trends on the actual cycle is the breakaway from first home buyers compared to investors. That sort of gap is widening now. Consolidated a little bit recently, but when we look back a couple of years, we see at one stage there first home buyer lending was actually higher than investors, which is unbelievable. To see that the proportion of first home buyer activity in the market higher than investors, and a couple of factors behind that. Of course, that was the period when we moved into COVID, but more rational in terms of that relationship is that's where we had that credit squeeze, where it was very difficult for investors, almost impossible for investors, not totally impossible, but it was very difficult for investors to get a loan. And that was that reflected in that meeting between the value of first home buyer loans and investor loans back in 2020. But now, of course, that gap has widened. And when we look at the results over the month, breaking that down, comparing it also to the year, first 5 months of this year compared to the same period last year and the full year, we can see fairly similar results over the month between the buyer types. Owner occupiers generally down 2.3%, investors down 1.3%, first home buyers down 2.9%. So reasonably similar results. However, the year to date certainly shows some strength in the investor market, which I guess is what we were just discussing, how that's become a lot easier to get finance for investors, and in a relative sense. And it's, even though first home buyer activity has still risen, it's still not tracking at the level of investors. So over the year to date, first 5 months of this year compared to the same period last year, investor activity is up nearly 30%, Michael, on that year to date comparison, and up 13% over the full year ending May this year compared to the full year ending May last year. So some very strong results there for investors. And not a surprise, prices are rising, rents are rising, yields are holding, and generally in a high inflation environment, there has been a little bit of a shift to property in terms of a preferred asset class, and particularly considering that the share market hasn't really done much, by comparison. I think it's interesting. I broke down the data into how the states are performing, Michael, and I think we can see some interesting results there. When we break it down into buyer types, the actual value over May for lending, and this is in millions of dollars, we can see owner occupiers, well, certainly New South Wales, with the exception of first home buyers, leads the charge with the value of lending for each of the buyer types. Of course, as we discussed before, that reflects also that high price Sydney market, that you have to borrow more to stay in that Sydney market. So no surprise that we have higher values of lending in New South Wales overall for owner occupiers. Investors also quite strong in New South Wales, again reflecting higher prices in Sydney, but I also think that there's more of a surge for investor activity in that Sydney market, particularly in New South Wales generally, because of the more consistency in terms of its price outcomes recently. But when we look at Victoria, it certainly has the edge in terms of first home buyer activity. In fact, quite clearly, lending is stronger for first home buyers in Victoria. And that's notwithstanding that Melbourne has certainly still significantly lower prices than Sydney, perhaps not at the bottom end, but still certainly an advantage Melbourne has for first home buyers with lower prices. And I think that reflects in that first home buyer lending in Victoria is the highest of all the states. And no surprise there that we see strong results for both Queensland and Western Australia, who have been strong movers over the past 12 months or more now in terms of house price growth and activity in the housing market. So some interesting scenarios there, and also investors quite strong in Queensland. which I think is interesting, Michael. Not that far below what we see in Victoria, investor lending in Queensland. Again, no surprise there. Very strong growth in that southeast Queensland housing market over the past year or two is certainly encouraging investors. So investors are very much part of the story in in the housing market activity currently, according to the home loan data. And when we look at the growth over the year so far compared to the previous year, you can see there Western Australia in terms of investor activity, Michael, up by 69.6% over the year. Again, no surprise because we've seen remarkable growth in Perth house price. But similarly, South Australia up 39%, Queensland 43.8% growth in investor lending. So those markets are certainly being fertilised. Their prices growth by investor activity. And I guess one validates the other or creates strength in the other with higher prices, creating more investors and more investors creating more demand and higher prices. And we can see still falling in terms of growth below Victoria, and that's no surprise because Victoria, although still a reasonable result there, 12% growth, and considering the price differential that we've got to take into consideration as well, because that's what's also driven those high growth rates in Queensland, South Australia, and Western Australia is natural inflation or the inflation of house prices. But again, we can see that there's been a strong revival over the past year in investor lending, and and that just reflects the strength of our of what's been happening generally in housing markets, despite all those interest rate increases, Michael.
And despite all the negative messages in the media, so it'll be really
Yes.
interesting to see what happens to investor activity when eventually, and it won't be for a while, interest rates fall,
Yeah.
consumer confidence increases, and over this year being an election year, I think a lot of uh, incentives will be hurled at first home buyers and
Yes.
possibly even investors. So that'll be interesting. Now, I know one of the things my housing markets keeps a careful track of is house building costs, because that filters through into construction costs, of course, for new developments, which currently aren't generally financially viable. And while overall we were happy that the cost of building seemed to be, well, the increasing cost of building seemed to be lowering. The cost hasn't lowered by any means.
No.
House building costs just crept a little bit higher recently.
Yes, look, the trend's been positive, and the reason, obviously, we focus for two reasons on the on house building costs, Michael. Firstly, is that it's an important factor in the ABS inflation model, the CPI model. When house building costs or house costs have been a significant factor in the rise of inflation over the past few years, and when the ABS measures the CPI in terms of house costs, housing costs, it looks at two factors. It looks at rents, and that's overall rents, not just asking rents for newly listed properties, but that's also existing rents. And it looks at house building costs, not apartment building costs, but just house building costs. So that's why we keep a track of house building costs, because it's important in terms of its contribution, significant contribution to the CPI. And of course, that relates to interest rate policy. But the other point, of course, is on the supply side. And we know that, the characterisation of Australia is accepted now that it's clearly undersupplied with property. And we need a revival to find some more balance in our housing markets, particularly our rental markets. But that's part of why rents are rising and prices are rising, but particularly rents, is that we have a shortage of housing. And that's been really been building now for the best part of a decade, and probably not much we can do about it. But certainly, one of those restraints is high house building costs, and as long as house building costs remain high or higher and are growing, at higher rates than historically at the historical averages, then it makes it tougher for builders to complete a project. We can get our building approvals, but whether they become out of the ground developments is another story because of the constraints of higher building costs. So we look at that carefully. And as you said, Michael, we just had the trend's been positive over the last couple of months, but it did pick up again over over May with a rise in the index, the overall index. And I think it's interesting because, as you mentioned, we can start talking about the year-on-year comparisons, which is what we look at when we're talking about inflation. But if we look at the actual increase in costs since we did move into this higher house building cost environment, it's really quite staggering because we've seen since COVID, which is 2 years ago, we've seen, 3 years ago, we've seen house building costs rise by 46.6%. So that's an average of 15% per year, which is quite extraordinary, Michael. So, if you're building a house, you build a house just before COVID, it would have cost you nearly 50% less in terms of the actual house building costs compared to, because that doesn't include the land, compared to what you pay now. And, that's still, even though the rate of growth is declining, it still reflects a significant impost to, us trying to match, or the market trying to match supply with demand at the moment.
I guess that also means that there's strong intrinsic value in a lot of established properties,
Yeah.
and particularly apartments. Apartments have been a little bit out of favour. They haven't grown as well in general as houses, but as you already were hinting, apartment building costs are going to be even higher than house building costs. But that until established property values increase sufficiently to narrow the gap between new and established properties, new properties aren't going to come out of the ground. And I think that's one of the reasons I'm confident in the long term, even in the short and medium term, about house prices in Australia, Andrew.
Yeah, that's right, Michael. And we see with and look, that's I mean, you're only building more value into the property by having to by costing more to build it. And the interesting thing is, Michael, when we look at the supply side data in terms of approvals, houses aren't doing too badly. We are starting to see somewhat of a revival in house building, still quite flat. Apartment building, as you said, is very, very low at the moment, historically low levels of apartment building when we account for the volume involved. But we're still 3.3% higher in house building costs now than where we were a year ago. But we have, as I said, had a pretty consistent downward shift. But just a pause in that, when we compare the year-on-year changes in the quarterly index, still rising at 3.3%, which is sort of well above what we would expect, certainly on average, for annual inflation of house building costs. So we're certainly not out of the woods, Michael, but the trend is clearly downwards, which is good. And we are starting to see a few more houses now being approved. Now, as we said, that has to translate itself into out of the ground jobs. But certainly some work to do still. And we have to absorb that near 50% rise, in a sense, in house building costs over the last 3 years.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. That's really very significant, and I don't think it's really played its way through in the markets yet. Now,
No.
with the cold parts of winter, especially in
Yes.
Melbourne, people have been away on school holidays. Almost everyone I know has been away in Bali, but some people have remained in Australia and gone to auctions over the weekend. How did the weekend auction markets fare, Andrew?
Well, I guess we could say finally we're starting to see the midwinter effect. As you said, many people are away, perhaps heading northwards, not just to Bali, but where I am in sunny Queensland. Sorry about that. But but we are starting to see fewer buyers, and that's no surprise because that's what we expect. We are actually dead center in the middle of August now, Michael, and still getting some quite hearty results, robust results for this time of the year, and nothing really changed. The clearance rates were lower, fewer buyers, of course, because they are distracted from through holidays and the midwinter hiatus in the market. This is the time really when the autumn selling season has run out of puff, and people start to think about a spring selling campaign or buying campaign. Buyers are sellers, sellers are buyers, and start focusing on their next property transaction being completed before the Christmas break. So that's what we usually see. That's why we see fewer buyers in the market. And it's also interesting, Michael, we also see that our median auction prices fall away as well because we see fewer higher priced properties in the market, again reflecting that holiday impact and also reflecting that sense that the spring campaign is more positive for higher priced properties. So all going according to plan.
Weekend, Andrew, you report the auction results every week, but you also break down the top results in each state, which you report on LinkedIn and I report in Property Update. And as we published the results for this weekend, there weren't very many high ticket property sales, were there?
Yeah, that's right, Michael. And it's more about the middle and outer suburbs, particularly the outer suburbs, rather than the sort of inner suburb higher priced areas. But that's what we see. And really it's been a bit long coming. It's been a later winter onset this year. Maybe it reflects the weather to some degree, but because it has been a later, I guess, typical winter down south, whereas it's been a later dry season up north. But certainly the results on Saturday showed lower clearance rates as a result of a more of a distracted market that we expect this time of the year. But even though those clearance rates were lower, listing numbers are still, quite high, Michael. So it's very much still a market that's, activated by sellers. And, it's, again, a reflection of the underlying strength of the market. But when we look at the results, numbers down in Sydney, 581 auctions in Sydney, down from 730. Of course, school holidays in New South Wales impacting that. Clearance rate down a little bit, still above 70% though, Michael, which you'd have to say is a seller's market result, above 70%. And the gap between this year and last year is narrowing a little bit there, with Sydney still lower than a year ago, but a similar result there. And its clearance rate wasn't that much lower than where it was a year ago either. Same story in Melbourne. Well, not really. Melbourne had similar numbers, higher numbers marginally than the week before, but a higher clearance rate, Michael. But as you said, when we look at the regional breakdowns, we can see that was really mainly fertilised by the outer east and the northeastern suburbs, which are mid-price suburbs, still quite active at the moment. But a good clearance rate there for Melbourne, 67.4%. Again, listings are still higher than where they were a year ago in Melbourne. I'd still say notably higher than a year ago, but the clearance rate is well down because that was the peak of that revival market in Melbourne a year ago. Big numbers in Brisbane, 107 auctions in Brisbane. Brisbane tends to be quite an active winter market, of course, Michael, which I guess maybe reflects that sunny, dry season that southeast Queensland's experiencing finally at the moment. Clearance rate, 45.5%, down a little bit in Brisbane, reflecting perhaps higher numbers. But again, we don't get too concerned about those around 50% clearance rates in Brisbane, while you wouldn't be if you're a seller, because there is a different culture there in terms of auctioning in Brisbane, but similar to a year ago in terms of the clearance rate, Michael. But look at the numbers, well ahead of where they were a year ago in Brisbane in terms of auction numbers. Numbers down a little bit in Adelaide, a clearance rate down a little bit as well, but still Australia's, or the capital city's top auction market, Adelaide. And after a couple of weekends of stronger activity, we saw that the Canberra market just tracking back to, I guess, what we've been used to earlier in the year, 50.9%, but following a very strong result the previous weekend. But again, the clearance rate and the auction numbers were well ahead of where they were a year ago, Michael, in Canberra. So we've been talking about a pickup in the Canberra market, still active, I think, but it is the winter market. We would expect fewer buyers and lower clearance rates as a result. When we look at the monthly total results for clearance rates, Sydney's still tracking well above 70%, 73.4%, which is not that dissimilar to where it was a year ago. So still a strong market there in Sydney. Melbourne still in the mid 60s, which I guess is all really tells the story for Melbourne, which has been, a reasonably solid market, consistent market. But I think, as we mentioned before, Melbourne's really a mid to lower priced market at the moment. And I guess that reflects that strong first home buyer activity and investor activity in Melbourne. And Brisbane just holding again. It's I guess its usual position around 50% and lower than where it was a year ago. But that again, similar to Melbourne, was the peak of its market, driven by all those migrants coming from the southern states. Adelaide, not that far away from a year ago, still pushing 80% clearance rate, which is a very strong result there, and certainly would be welcomed continuously by sellers. And Canberra down a little bit with that weaker result at the weekend. And we're still waiting for a consistent revival there in Canberra, although certainly June was a much better month for that Canberra market. And we are starting to track higher prices coming through in Canberra, but we'll have to wait through that spring season. Of course, you can get the full results, the Capital City Snapshot, around about 6:30 every Saturday night on my LinkedIn channel, Dr. Andrew Wilson at LinkedIn. Which gives you the clearance rates and the listings on the date. And then we have the full national report, which is released through Michael on Sunday and through my LinkedIn report around about 9 o'clock on Sunday. And if you missed that, we'll have a QR code in a second. But as we keep reiterating, we're still seeing record listing numbers through to date for this time of the year compared to the same time last year. Sydney sales, given higher listings and still solid clearance rates, where we look at sales rather than clearance rates and listings, sales are up 32.8%. These are properties reported sold under the hammer on the weekend. Melbourne up 24%, Brisbane up 20%, Adelaide up 13%, and Canberra now up 4% in terms of the number of properties sold under the hammer. So again, a real validation, Michael, of how strong our housing markets are. Certainly consistently solid and plenty of buying activity happening. In fact, record buying activity for the first half of the year. If you're looking for a copy of that auction market report, there's a QR code which will take you to the latest national weekend auction market report. So another busy week in property, Michael.
There always seems to be things in property, Andrew, and despite all the negatives thrown at our housing markets, continuing strong sentiment has meant that the market just keeps moving on. We'll be catching up each week to discuss the latest news and trends, Andrew.
That's right, Michael. Next week we will be talking about particularly the latest unemployment number, which comes out, and we'll have some, I guess, guidance in terms of where interest rates go.
That'll be very interesting. Catch up with you next week, Andrew.
Thanks, Michael.